Hello, this is Todd Bailey. I am from Fortress Risk, and my brother Rick Bailey of Camus asked me to cover for him today and to talk about captive insurance. What I have is just a short overview of something we did for one of our clients. The client is a physical therapist. He has a series of clinics. He's out in the Midwest. And we were able to do some things that worked really well for him to manage risk and also take care of some tax planning. In fact, that's where captive insurance really shines. With captive insurance, we're able to cover risks that are excluded from commercial policies or risks that simply aren't covered by commercial policies. Additionally, we're able to get a significant income tax deduction to help manage the tax load. And we create some resources, some funds inside of a captive that can be used for other planning for the client. Now, in this case, we had a client with a lot of different risks from multiple locations for a physical therapy group. We looked at all the different risks for the business. And in this case, I'm going to focus on just a couple. First, we focused on the commercial policies, making sure everything was adequate. Then we looked beyond the commercial policies. And in this case, I'm looking at two policies in particular. We were focused on the employment practices policy, which had some exclusions, which is not unusual. You'll see with most of the clients that there are some things like sex discrimination that are not covered under typical EPLI or employment practices liability insurance. We were also concerned about reputation because for a physical therapist working in somebody else's bubble, the reputation risk is really significant. So we're focusing on those two risks in particular today. When we do this for a client, we're looking at all of the different items that feed into the risk profile. So we're going to look at their tax return. We'll look at their current commercial policies. We'll look at their claims or loss history to develop the data that we need to gather the facts that we need to be able to work with our insurance actuaries. So we take all of that data and then we develop a list of coverages that the actuaries can work with. And again, I'm just going to focus on a couple today, employment practices and reputation. The employment practices policy, there are some exclusions in the commercial policy and some things that are simply not accounted for. And that's not unusual. When we get the actuaries involved, when we're looking at a risk like the employment practices or the reputation, the actuaries are focusing on frequency and magnitude of a potential claim because they need to build the policy and determine the appropriate premiums for the policy. And they're keying on frequency. How often do we expect a claim to occur? And then for magnitude, when it occurs, how large do we expect that it will be? And we've got to be able to gauge both using math models and statistics. With those key inputs, the actuaries can determine the appropriate level of premium for a given coverage. When we work with our actuaries, we get a report back summarizing a variety of the inputs. And in this case, I'm going to focus on the frequency and the magnitude. For the employment practices, the actuaries looked at the history for this particular group of clinics and the industry in general and determined that under the employment practices policy for the things that we would cover, there was a 9.4% probability of a claim this year. So a significant possibility. Under the reputation risk, which we bundled with business interruption, which kind of goes hand in hand with the reputation risk, they determined the risk was about 5% chance. But in the case of the reputation, if there is an event, the probability is pretty high that it will be a large impact event. The policies in this case are $2 million policies for both the employment practices and the reputation risk. And it's significant that based on the data, the actuaries determined that there was a 60% chance that if there was a large reputation event, a 60% chance that the magnitude or the measure of the loss would exceed the coverage. I said it's $2 million. So a 60% chance if there's an event, it will go beyond a $2 million impact to the business. So pretty darn significant. Using those inputs, the actuaries determined that the premiums for the employment practices would be about $23,000. The, the, the reputation risk has premium of 134,000, and that's due to the possibility of a high magnitude event. We're covering both items, and it's interesting. We had those coverages in place a few years go by, no problems in those areas, and then something odd happens. Our client has a bunch of physical therapists. One was pregnant, and she needed to take several months off as her pregnancy was moving along. She was 5, 6 months in, and the time was coming when she was going to need to take some time off for her pregnancy. Our client advertised for a temporary physical therapist and clearly advertised that this was to cover a pregnancy because somebody needed to, well, one of the therapists needed to take some time off. One of the applicants that showed up for an interview was a woman that was also quite pregnant. In fact, due at about the same time as the therapist who needed to take time off. So, of course, our client had to decline hiring that person because she was going to have a baby at about the same time, and it just wouldn't work for this little gap coverage. Well, about 10 days later, 10 days after declining her application for employment, my client was hit with a sex discrimination lawsuit because my client declined to hire the pregnant woman to cover the pregnancy for the therapist that was also pregnant. Just a garbage lawsuit, but it created a real difficult situation for my client. They could fight the lawsuit. That was one of the choices he had. They could fight the lawsuit, and it would have been a very public event, the kind of event that gives rise to reputation problems. There was a good chance that it would be a long, drawn-out, nasty affair. Ultimately, our client would prevail because he did the right thing. He simply couldn't hire this therapist that was already pregnant. But at the same time, the clinics couldn't afford that kind of bad PR. So the client called us up. We looked at the policies and determined that it would be appropriate to submit a claim to take care of this garbage lawsuit. We had coverage under both the employment practices. Alternatively, we had coverage under reputation risk. And because we had coverages in place, we were able to determine the likely magnitude of a loss. And from that, we were able to measure a claim, and we worked out a settlement for this garbage suit. That's unfortunate that we had this garbage lawsuit. In fact, it's always unfortunate when you see something like that impacting a business. However, this client had in place the protection to take care of an event just like that. When the claim was submitted, we were able to measure the likely impact, offer a settlement, and when the settlement was paid, half came from the captive insurance company for our client. Funds were already set aside for that. The other half came from the captive insurance pool that all of our clients participate in. So it worked out really well. That took care of the risk problem, took care of the exposure that our client had. Now, on the other hand, that same policy can serve, or those same policies can serve other purposes. For example, based on that premium, that was about 23,000 from the employment practices, 134,000 for reputation risk. The same policies can accumulate the premiums year by year, and based on our history of expenses and loss ratios, at the end of 10 years, just based on those two coverages, the client would have about $1.8 million accumulated in his captive insurance company. That could be used for retirement or all sorts of things. Also, along the way, those same funds can be used to buy life insurance. That money from the captive can be withdrawn from the captive to buy life insurance for estate planning, for building up a cash value policy for retirement, maybe a buy-sell for a partner. There are all sorts of things that can come from having that pile of cash that's being built up. And by the way, it's being built up with a tax deduction for the business, tax deduction for, in this case, the physical therapy clinics. And when it's received by the captive, it turns into profit. The bulk of it is profit, and the tax rate is 0 on the insurance profit. No tax at all. So that's accumulating in an investment account for the captive. They can build up, like I said, for retirement, or it can be used for other things like buying a nice life policy for all sorts of different solutions. And in this case, the premium for just those two coverages, that's 2 out of about a dozen we have for this particular client. That's enough cash flow to support an insurance premium going up to life insurance of about 125,000 per year in premium. That solves all sorts of problems for the client. Captive insurance is a heck of a tool. For this client, it solved the risk problem, and it's going to solve a retirement issue, and it will help him buy out a partner and address estate planning. It's a heck of a tool. Find ways to get it into your arsenal. Find ways to serve your business clients. That's all I've got for today. Again, it's Todd Bailey from Fortress Risk.